Hello, good afternoon, good morning, and good evening, everyone again. As I see, people are still joining, but we're at the top of the hour, so let's kick off. Very warm welcome to everyone to this webinar, which is actually the kind of global vote of the public consultation of the impact-weighted account framework. We're going to look at how to pave the way for long-term value creation for all, which the IWAF sets out to do. We have a distinguished panel here today, great speakers, great insights from all walks of life. Very excited about the conversations we're going to have today. So we would like to, of course, obviously keep it interactive as much as possible. Please do share your questions along the way, share your insights and feedback. That makes it much more interactive for all of us. Knowing that we have a lot to go through and great content, I would like to end the suspense and hand over to our first speaker, Ethan Rowan. Thank you for joining us. You're Assistant Professor of Business Administration at Harvard Business School. And I think it would be great to hear from you to start setting the context of what IWAF is setting out to do and your perspective. Thank you so much. Over to you, Ethan.
Thanks so much, Esther, and I'm so thrilled to be here today. I was in a meeting last week, a kickoff group meeting for a working group that I helped to lead on how businesses can more closely align themselves with the UN Sustainability Development Goals. And we warmed up by going around the room and saying what we were most thankful for today. And usually when I get that question, I say I'm most thankful for my dog. But I just blurted out that I am so thankful for the huge uptake and momentum we have around impact accounting across the globe. Impact accounting is now being used on every continent. Here at Harvard, and with the Impact Weighted Accounts Project, we have diverse partnerships with important players from investors such as BlackRock and Calvert, who are using impact weighted accounts to make investment decisions. And this is incredibly important. If you think about, these are universal owners. They care about systematic risk. They don't necessarily care about alpha, but without something like impact weighted accounts, they can't well identify that systematic risk. We also have private investors who are using impact weighted accounts in management decisions. Rainier Indal, our good friend who you'll hear from in a little while at Summa Equity, has been using impact weighted accounts to help guide its portfolio companies in management decisions. But this methodology is incredibly flexible, and we see it being used in the public sector as well. The Fresno, California Economic Development Commission has been using it to figure out what kind of businesses it wants to attract. Governments use tax incentives, use various incentives to attract businesses, but the goal is always what's best for their constituents, for their voters. And impact weighted accounts gives them a tool to better identify what's best, which businesses they want to attract. And lastly, we're starting to see some industry cooperation. We're seeing the Banking for Impact Working Group has been using impact weighted accounts to set rules for banking. But I'm getting a little ahead of myself. What is impact-weighted accounting? I'm sure we'll have time to go into the real nitty-gritty, but to give you a brief overview, IWA is a way to measure the impact that firms' operations have on their stakeholders. When at IWA at Harvard, we think about these stakeholders as being the environment, employees, and customers. And you can think of impact-weighted accounting as an earnings report for these groups. It's not dissimilar from what you would give to shareholders in terms of the content you want to convey. And to make it comparable, we use academic research to convert these impacts into dollar values. And this allows comparability across diffuse topics, which improves managerial decision making. You can think about the trade-offs. It's hard to think about the trade-offs of a project that would mitigate carbon emissions from one that would improve the lives of employees. But when we attach dollar values to it, it starts to make it more clear the best strategy we can use. Still, creating the system is hugely challenging, and the challenges vary by stakeholder group. The environment, we've had the most progress. It's possibly the easiest, largely because of the combination of available data and the extensive research on this issue. We have good estimates of firms' carbon emissions and the price of carbon, so we can measure that impact. Still, when we get into scope 3 emissions with issues such as product usage, it becomes more challenging, and resource consumption is also a big challenge. If you think about something like water consumption, it's a much bigger issue in a place like Arizona than it is in a place like Minnesota. So on the employment side, the designing of the accounting technology was also somewhat straightforward. We want to think about how well firms treat their workers and how good jobs are distributed among the population. Execution, though, still remains a challenge. Data are difficult to identify, and issues like diversity and living wages vary significantly across countries. So it's hard to generalize across geographies. But the good news is that at IWA, we've been able to identify large-scale data sets that allowed us to move these methodologies beyond case studies to test how impact relates to firm performance across the economy. And we find good news. For the environment, we find that lower negative impact is associated with better firm performance and lower volatility. Basically, firms that care about the environment do better for their investors and are more reliable. On the employment front, again, looking across a large section of the US economy, we find that firms that have more positive impact on their employees have greater value and lower turnover. Now, product is probably the biggest spare, though. Our framework takes into account the availability, quality, and efficiency of products. But because products vary greatly across industries, it's challenging to do large-scale analysis. Here, though, we've honed our methodology for various industries to make it plug and play for managers who want to examine this internally. Externally, though, we're doing this industry by industry, and I'm now working on an article that measures product impact for the financial technology sector. And this has been actually pretty eye-opening for me. I've been working on this for 3 years now, and starting on this fintech project, I realized that fintech is the industry that gets more impact dollars than any other industry across the globe. This is the place where ESG investors are putting a lot of their money. And yet, the fintech industry promises financial inclusion and security, and that's why they're so attractive. But there's been little accountability because there's been no measurement. And so you see why impact-weighted accounting can be so important. They can't make the best decisions about which of these firms are having the biggest difference on their customers' lives without some kind of product impact measurement. I'm really excited to speak to this group and meet with you to discuss impact-weighted accounting, though. The framework is there, and it can be implemented by managers and investors to start making decisions immediately. It'll never be perfect, but as John Maynard Keynes said, it's better to be roughly right than precisely wrong. And that's what our mantra is. That's what happens across all accounting information and accounting technologies. The question should never be, is this perfect? It should be, is it good enough to achieve our goals? And while the methodology will continue to evolve as we get more buy-in and feedback and data, I'm confident, and I hope you are too, that the answer to this question is yes. IWA can achieve the goal of understanding firms' impact on stakeholders in a way that reshapes the conversation. Right now, much of ESG is about risk mitigation, but we believe that's not enough. And that's where IWA really differentiates itself, because given the magnitudes of the issues we are exploring, risk mitigation is insufficient. IWA gives us the tools not just to ask whether we're limiting our risk, but also to understand how business can start having a lasting, meaningful, and positive influence on the societies that give them their license to operate. Thank you again so much for the time. I'm really looking forward to the panel and all of your questions.
Thank you so much, Ethan. I think it's so important that you pointed out right away to look at the impact-weighted accounts as a continuum, as the next step, as the next frontier, moving beyond ESG, and how this is kind of the North Star we need to be working towards. So I think it really sets the frame. And it's also great that you could share these opening remarks in the context of obviously the Harvard Business School being one of the key contributors and pillars of also of the working group that has been working on the impact-weighted accounts framework draft that is now being launched for public consultation. But obviously there have been also other entities involved very much in the development of this first draft, including also the Singapore Management University and Haliang, we will speak in on the panel later, but also the Erasmus School of Management of the University of Rotterdam, and obviously very much spearheaded and owned by the Impact Institute and the Impact Economy Foundation, the backbone behind this project. So it's great to kind of bring it all together and have your opening remarks to set the scene. And I think it would be also very natural to move from here and hand the word to Adrian de Groot-Roys, who is the co-founder and director of the Impact Institute, to give your perspective and the history behind the work so far.
Thank you, Esther, for the floor, and thanks, Ethan, for his super concrete introduction. I think one of my roles, I'm doing this together with Rob, and we divided that I will say a bit more about what impact-weighted accounts are, and Rob about what the impact-weighted account framework is. And I also will take a little bit of time for the opportunity to explain why this is such a historic moment, because the people who developed this are brilliant minds who are super modest. So I can take a bit of time to also point out how valuable and historic this work is. Just to see if I can. Yeah.
Thank you. And indeed, apologies for that. Great, obviously, to do this together with Rob. And Rob, you've been very much contributing throughout the process of the working group as well. We were thinking of doing a quick poll, and I'm just looking to the Impact Institute colleagues and the Impact Economy Foundation colleagues. If you think you can do it real quick now to set the scene also for Adrian and Rob's input, or wait until after. Here comes the poll. So what is impact measurement? Have you worked on measuring impacts before? Is it a simple yes or no? Curious to see the feedback from the audience. Do we see the results of the poll coming through? Let's just assume many of our viewers have some experience. Yes, here it comes. It's now 68% of our audience has worked with measuring impacts before. And obviously, you know, what do you mean by measuring and what do you mean by impact are two subsets of questions we could dive into in more detail. But I think that gives a really nice context to kind of the audience we have with us today for Rob and Adrian. But before that, there's two quick more questions, I think, that should pop up. Let's go for the first one. The first follow-up question from the have you measured impact? Do you feel your organization is in control of its material impact? Again, I think the way you answer it now at the beginning of the webinar may be different than you will feel about it towards the end, but curious to see how you feel about it right now. Do you think your organization is in control of its material impact? Very interesting question, I would say. Very much on top of mind. Oops. So here we see that 63%, almost 2/3 of you said, no, you're not in control of the material impact. And well, a very good question will be, can the impact weighted accounting framework help you to become more in control and then get a better understanding of the material impacts? With that, the third question is, how much impact do businesses have on the future of the world? That's a very big picture question. Businesses today, what is their impact on the future of the world? Curious to hear what our audience thinks. A very large impact. So 92% of you have said very large impact, and just 8% small or medium. Well, medium was 5%, small was 3% in terms of the answers. So this gives a clear mandate to businesses and the call on businesses to take accountability and responsibility for their impacts and manage them. Now, how to go about that is exactly what we're spending our time on today to discuss, and gives you the opportunity for the coming months to also give feedback on that in the impact-weighted accounting framework. But I think with this context, Adrian and Rob, may I again call on you to take it away?
Sure.
Thank you.
Very interesting questions. And then I will see if I can share my screen. So I hope it is visible to all our participants. And as said, I will dive a little bit into what are impact-weighted accounts, and then Rob into what is the impact-weighted accounts framework. And then from the Impact Economy Foundation perspective, I'm one of the board members. So our starting point is that it's really taking a market-based approach. So that we've seen in the past 2 centuries that market-based, profit and price-based economies have brought a lot of material welfare. If you look at the GDP per capita in the past 2 centuries, since the Industrial Revolution started and markets started to take hold, the GDP per capita has increased by 10-fold on average in the globe, and in some parts of the world by much more. So that is very, very valuable. And also, if you look at the past 50 years, almost 2 billion people have been lifted out of poverty. There's still many in there, but 2 billion people living out of poverty is not a small feat. At the same time, we're all aware that there are massive costs to our current economy. The central banks have estimated that climate change, just looking at the financial impact, could lead to a 25% decline in global GDP. As alarming as climate change is, at least that the biodiversity impact of our business operations. 1 million species are estimated to be in risk of extinction. And well, although climate change is super important, we cannot really make use of our good climate if we don't have biodiversity, if we don't have soils to grow our food. And on the social side, for example, we're still dealing really with the consequences of a system of slavery that was terminated like 100 years ago. If we think about Black Lives Matter, very important. And at the same time, there are more people than ever in our economy in situations of forced labor at this very moment. And 20% of the people who work are poor, are working poor. And in some parts, for example, agriculture in Africa, that's the majority. So the majority of the people who work hard are below the poverty line. So the question we kind of have is, how can we change and use the power of markets for the greater good? So that is also what we see as one of the biggest opportunities of this century, is creating an impact economy that creates true value. So where the work that we do, entrepreneurship, innovation, technology, does not only work to accumulate more financial capital, but to create value for all of the stakeholders. And that is, of course, a big shift. Many of you will be familiar with the Friedman Doctrine and what he wrote in 1970 in the New York Times, that the social responsibility of business is to increase its profits. And a very interesting article listed almost all of the CEOs of the major companies saying, this is what I was taught at business school. This is how I thought that I should run my business. So it has had a massive impact. And you now see 50 years later, approximately, that there is a different mindset, so that many believe actually that the purpose of business is to create value to society. Well, there's still many Friedman acolytes, so to say, but it is a species on the brink of extinction, I would say. But then that raises a question: if we really, as Ethan also said, want to go to a different mode of doing business, there's one quite large blocker, that we see it as a black screen, that most businesses actually do not know what their impact is. So, and if they don't know it, they can actually not manage it. And so one of the subtitles of a report by colleagues of Ethan, by Rob and George, is that the missing piece for an impact economy are impact-weighted accounts. So we can have very good intentions, but if we don't know what the impact is, we can also not manage it. Now, it's not that there's a lack of information, and that may also be a question that you have, okay, but there's a lot of information on ESG and sustainability, and that is growing. And that's definitely true. And where we see that the key challenge is that even though there's a lot of information, it is actually not fit for purpose to make decisions. So the beauty of financial information, I come from a finance background, is that you can make decisions. It turns very different things to very different startups, scale-ups, listed companies. It turns them back into a certain return so that you can choose. And currently, all the information that we have is a smorgasbord of data, but it doesn't allow us to choose. So that is a big problem. So the simple question that stakeholders, businesses, and their stakeholders need to answer is: should I choose A or B? Investment A or B, project A or B, product A or B? And that is the type of question that impact-weighted accounts can answer. And it's a little bit more complicated than financial accounts, as you don't care just about one thing. And we don't want to bring everything down to a single dollar value, because you probably want to create value for each of your stakeholders, not only for your employees, but you also need to create value for your shareholders. Otherwise, you go bankrupt. And you don't want to create value for your clients at the expense of society. You want to act sustainably within the planetary and social boundaries. You want to contribute to the SDGs. So if you have these different perspectives, how can you make an informed decision about what to choose? And that's the simple question that impact-weighted accounts can answer with all the limitations that Ethan mentioned. And so to make it concrete, often you get a question, okay, but how does it work? So very highly stylized example from people working on this. Suppose you have a certain innovation that can actually contribute to something. And then you can say, okay, it has different impacts. First, identifying it. And impact-weighted accounts help you identify it. For example, less methane emission, less water use, but possibly extra accidents. And if we just take, for the sake of time, the methane part, suppose per installation you have 10 tons of methane per year that you save. Well, a ton of methane has approximately the same effect, global warming potential, as 21 tons of carbon. So then you have 210 tons of CO2 equivalents. If you look at the social cost of carbon, for example, then stylized, you can take it at around $150. Actually, it is increasing in the past years, but if you take 150, they say, well, we have 210 global warming potential, $150 per ton. So then it's around $31,000 of global warming savings per installation. And then, of course, as a business, you're creating value with others. If you make the installation, your clients are actually making the product using the installation. You have suppliers, so only part of that impact you can attribute to yourself. Suppose it's 50%, then you have around 15,000 of benefits in carbon. And if you do that for the various impacts, then you can have a complete picture in which you can also compare two different types of options. So that's a very briefly stylized example. So if we go to the definition that's also in the IWAF, that says it's a set of comprehensive, quantitative, and valued accounts containing impact information about an organization that they and their stakeholders can use to make informed impact decisions. So in a way, it's very similar to financial accounts, but then you have the double materiality. So you not only care about your shareholders, but about all stakeholders, and you look at the various capitals that you need. But very similarly, as financial accounts, you have line items in various statements, and that gives you information that you need to make decisions. So with that, an example, also as Tjeerd Krumpelman from ABN AMRO is in the panel. So they have been using one of the precursors of the impact-weighted accounts framework. And they also publish for various years now an integrated profit and loss statement, where, as you can see, you have the various line items for the various stakeholders, the various capitals, and that gives information on that. And for example, they've zoomed in on biodiversity and biodiversity loss, and that if you would look from 2020 to 2021, they can quantify the improved impact on biodiversity at around 17 million. And that's really the impact attributed to them. And so that's part of the total impact, but really what they would be responsible for. So that is an illustration of the type of information you get if you use impact-weighted accounting. And then there are various benefits, and Ethan has mentioned quite a few of them already. But one of it is probably that, as we saw in the question, you can be in control. Because if you're a CEO, board member, it feels very uncomfortable that your stakeholders ask you about climate change, biodiversity, labor rights, equality. What do you think about gender? And you don't know, and you're not in control. This provides you a way to become more in control and make decisions in a good and informed decision manner. So with that, I would like to give the floor to Rob, who knows also much better about the content of what actually now in the framework.
Wonderful. Thanks everybody for being here. This is really a momentous and sort of really exciting day the public consultation period is a critical part of this work, and making sure that it is fit for purpose in the various contexts, right? Whether it's corporate, investor, or public policy venues in which we hope this to be really helpful. So we really appreciate your time. It has been such an honor to work on this project with the working group team and with the Impact Economy Foundation. So if we could flip to the next slide, and I will say so. I oversee the impact weighted accounts project from a sort of project management perspective, working very closely with Ethan and George. And thus far in our life, right, or actually sort of starting in late 2000, I think we started talking, 2020, I think we started talking about this with Rainier. We had really focused on the technicals of what Adrian just described, of like, how do you get to the number, right? What is the number across the various pillars of environmental, social, or product impact, right? And yet behind me, I knew, and this question kept coming up in criticisms of this work and this project of, oh, but you just get to one number, right? And you just net it down, right? And so people talk about that as sort of taking away from impact weighted accounting. And so I knew that there had to be a body of work that went up one level, right, to sort of 10,000 feet, and really laid the groundwork for the ethics of displaying, the ethics of calculating impact weighted accounts, what can be netted and what absolutely cannot be netted, so that we don't sort of revert back, from a lot of really well-intentioned work that is displayed in this slide, which aims to create a broader stakeholder base in our economy, right? And so I think this slide really bears mentioning that this work builds upon decades of work around standard settings, around metrics definitions, and sort of definitional work that is really critical. And we see ourselves as an evolution. We see our work as complementary to, not in competition with, those other pieces of work. We maintain close conversations with all of the stakeholders on this, and both Impact Economy Foundation and IWAI are members of the Value Accounting Network, which is facilitated by Capital's Coalition. And so again, this is not in any way a replacement of that work. It's really just a sharpening of the pencil as we try to really understand and what impacts businesses are having, what legitimate value creation looks like within a company, and how to really help those corporations or investors make better capital allocation decisions. Next slide, Adrian, if you can. So again, the goal of this is to provide concrete guidance to organizations on looking to implement their own impact weighted accounts. All of our methodology on the actual calculation is public. It's posted on our website. Value Balancing Alliance has also put forth a public methodology in the Transparent and Aligned projects. And so being a public good is a key ethos of ours. But when it's a public good, right, you do lose an element of control, right, of it, the correct use, right? And so we really want to guide organizations to being just and ethical, so that they can really manage the benefits for their key stakeholders. And again, a critical component of this framework is that it's publicly available, right? We don't think this knowledge, we really want, I believe strongly in the democratization of impact and impact thinking. So and again, it does allow organizations to tailor it up and down, to start small and grow bigger. And again, this is not just sort of this is a broad stakeholder base. I'm so complimented to be alongside my colleagues who wrote this from Singapore Management University, Rotterdam Impact Institute, and the Impact Economy Foundation. So next slide, Adrian. Again, I've dealt with a bunch of these things here. So we'll go through this actually rather quickly, Adrian. I think we can skip to the next slide. As Adrian talked about, there's two components, right? There's the impact P&L and there's the integrated balance sheet. I will fully admit the integrated balance sheet. I wrote that element of the work here, and it is an area for further development, mostly because it has to go in conjunction as well with some work on intangible assets that's happening throughout the accounting world. But as you can see, right, we do believe in that each stakeholder group, right, each capital group deserves to know in a very clear sense in either the balance sheet or the ip&l what was added and what was subtracted from them, right, both as from their stocks and a flows perspective, and to have that be very transparent. So open source and transparency is another core ethos of our work, right? And so it's important that it be fully known to corporates, to their stakeholders, and to investors, right, the decisions that were made. So while there are trade-offs, and people often in the impact space come from a very good space of not wanting to talk about trade-offs, the fact is I worked in business for many years before I came into this space, and that's what happens, right? There are finite resources, and so, but being able to understand which trade-offs were made is a critical component. So next slide, Adrian. So again, a lot of these steps here you will recognize. I think we added step 10 here versus the natural and social capital protocols, right? What we have done is really try to add a lot of concreteness into steps 6, 7, 8, and 9, right? To go a step much more concrete with very clear rules and principles that outline those, right? And yet again, talking about complementarity, we see this as building on and complementing. One thing I will notice, right, as you read through it, you will see a lot of elements which are extremely closely, if not directly, some especially in the introductory documents, which are directly pulled or referencing to the natural capital and social capital protocols and other bodies of work. All of it is footnoted, etc. And the reason we've done this is because many users of these documents, in fact, myself, have noted the importance of having a single sort of self-contained document. Because sort of as if you are a corporate user, right, the space goes very quickly to an investor, and having to then put down the current document and go see the foundational steps in another document can be challenging, right? So that's just to orient you. Next slide, Adrian. I'll move through this a little faster. So there's a number of key documents that are a part of this, right? So there's one, right, which is not sort of mentioned here, but which I think is actually important, which is it's at the very end, sorry. This is an updated slide. So, right, so we have an introduction, right, for those that are starting off at the 101 level. What is impact weighted accountings? What is impact actually? How does it move beyond sort of the inputs and output measures that we are used to seeing and reporting, right? And this is for people just wanting to get into the space and understand it. Then we go into the conceptual framework. What are the key foundational concepts that need to be understood before you can really get into the work, right? And so, and then we get into, so that's the high, that's sort of the 201 level, right? And then we get into the 301, which is the actual framework itself, which is really, and again, we keep adding sort of stakeholders and audience here in depth. So what are the key definitions? What are the principles and requirements? What can be netted? What can't be netted? What are the actual principles for when you lay out your impact balance sheet or your impact profit and loss, and really getting very specific into how you can do that. And then there's additional support documents here. We really try to break it down, create some fast reference guides for you. And the document that I think is really important as well, right, and the one that I was going to talk about right away up front is the FAQ, right? Which helps to answer a number of key fast questions that we get from especially that came up in our expert consultation, but also to really help you to understand the landscape of various frameworks and standards that are out there, and how we view our work as additional to and complementary to. So that's a high level, sort of 90 mile an hour, I don't know kilometers per hour, but breeze through it. Yeah. So. And here's the last element here, and I'm being called on time, so sorry for that. But what you should all know is we've already gone through an expert consultation, right? So this is sort of the second or third edition of this work. That is not to say that that the public that's not to dismiss the public consultation period. That's just to say that the work that you are already seeing has not been done in a vacuum. We've already vetted it. We are now here Thursday, June 2nd, and this is the public consultation period. And so this goes out to a much broader audience, but a very, very important one. As I mentioned, we want to make sure that this works for our broad constituent group. That is always challenging to do. Sometimes you may try to make something applicable and valuable to everyone, and then it becomes valuable to nobody if it is distilled. But it is very important that we get your feedback and are able to incorporate that. And so this period goes through September, and we are very excited to have you part of it. That's it.
Thank you so much, Adrian and Rob. And it was just, I think, so insightful and so clear to kind of go through the why and the how does this kind of framework look like in its consultation phase. Hugely helpful. I think it's very clear. I also see in the background a lot of questions and answers ongoing. So the dialogue is happening. That's wonderful. Please keep your questions coming, and we'll try to answer them. You can hopefully see them already now popping up the answers. And then if there's still outstanding questions, please do raise your hand and we'll get to them. That's the point, to increase the interaction and then answer your questions. So I think to build on the keynote from Ethan and the very clear introduction and the scene setting from Adrian and Rob, it is a huge pleasure to introduce Hajar Yakubi, who is a former UN delegate and a member of the 2100, which is maybe something she can tell us about a little bit, as it's probably more known in the Netherlands. And we have a bit of a global audience with us today. So thank you so much. It will be wonderful to hear from you about kind of what the impact-weighted accounts framework can mean for the future generation. What's its big picture purpose for the future? Over to you, Hajar.
Yes, thank you, Esther. Thank you so much. And indeed, I will tell you guys a little bit more about 2100, throughout my contribution. And you mentioned it already. I was a former youth representative. The moment that you develop like the slightest wrinkles, they usually kick you out. So that's how my mandate ended, unfortunately. No, of course not. But I do want to tell you a story about my time as a youth representative. I want to tell you a story particularly about a conference that I visited back in 2019, which was the United Nations Climate Action Summit. Now, it was quite a hectic conference. It was visited by a lot of heads of state, business leaders. There were diplomats, other youth representatives like myself, and many other people. And usually, whenever there is a conference of that magnitude, the ambassador of every country would usually organize this fancy delegation dinner at their house to commemorate, the assembly of all these different people at the conference. So that is exactly what happened. I was at the Climate Action Summit, and before I knew it, there was an email in my inbox inviting me to attend this delegation dinner, which I did. Now, I can tell you it was a really nice dinner. It was a lovely dinner, apart from the stress that I had about which of the 7 spoons in front of me I was supposed to use to eat my ice cream because it was really fancy. But I can remember one thing distinctly about it, and that is that at some point after the dinner, I was walking around the residence of the ambassador's house when I noticed a man with neatly combed gray hair. He was somewhere in his late 50s, wearing a gray suit. And it took me a moment to realize that that man was the CEO of one of the largest oil companies in the world. So before I knew it, I was walking towards him and I walked up to him to ask him what his role was at this conference. I was genuinely curious to know. Now, when I asked him, I remember that he took a moment to look me up and down before he answered my question, and his eyebrows were drawing together when he finally said, well, sustainability is incredibly important to the purpose of our company. And before I could so much as open my mouth to comment or question, ask another question, he pulled up the sleeve of his jacket, checked his watch, and excused himself from the conversation by saying, sorry, but I have to go now, long day tomorrow. So there I stood. I had no chance to ask him another question or comment or have a conversation. And I had plenty of other questions that I wanted to ask. Now, also to be really honest with you, I don't know exactly why I walked up to him in the first place, but I do believe that perhaps it was to create some form of accountability by asking questions. Now, what I do know is this. We can all see that it is no longer possible for us to live in a world where businesses create unchecked negative consequences that governments then try to remedy at huge costs. And I mean, we have within the sustainability movement for the longest time, and even to this day, still primarily focused on remedying those effects and those consequences through incremental taxation, through some rules and regulations, through subsidies, and even try to remedy those effects by walking up to CEOs at fancy dinners for some hope to ask them a question about accountability. However, we have done so without focusing enough on the primary reason as to why those costs to society are unaccounted for, which is that we are not looking at the actual rules of the game. Now, what is the rule of the game, you might ask? It is the accounting standard. And the real question is, why have we not, put more public pressure on it, put the limelight of the public on the accounting standard setting process? And actually, to figure that out a little bit and just brainstorm about it, I have been, in preparation for the consultation launch today, been testing something for the past few weeks. So like for the past few weeks, whenever I've been speaking at events or speaking with people directly, I asked them whether they know the IFRS, whether they know US GAAP, whether they know the IASB or the FASB. And I can tell you that nobody that I spoke to knew the IFRS or the US GAAP standard. There was even one guy that I spoke to that was convinced, like wholly convinced, that the IFRS was a football bond and that it was in some way related to FIFA or to UEFA. But you're guessing it, right? It is not at this moment. The entire accounting standard setting process is this black box to many people that is moved away from the public sphere. We need this accounting standard setting process in the limelight. We need a popular movement that makes sure that we can make sure that that accounting standard becomes material and that we can hold the people setting it accountable in that sense. Now, I promise you to also speak a bit more about 2100. 2100 is a network of aspiring young people who want to become executives or non-executives. And it is also a network of incumbent executive leaders, all of us gathering together to make sure that we can bring broad prosperity to the boardroom. And with Network 2100, we are already pleading this case about getting accounting standards that ensure that we take responsibility as companies for our environmental and social impact, for example. And, pleading that case that we need the true value of corporations represented is incredibly important. And that is also why I think we can all say that is amazingly exciting that we are able to gather here today, right, for the launch of the consultation of the IWAF, also as an open access framework, which allows companies to do just that, show the true value of their corporations. One big shout out to Rob and Adrian just now, because they already stated a lot about IWAF. And indeed, I mean, as they said, through IWAF, companies are enabled to, instead of solely measuring financial value, also measure in an equal manner their environmental capital, their social capital, human, intellectual, and manufactured capital. And I think we can all celebrate the fact that there is, I mean, one hell of a framework on the table now to do that. Because here's the thing, when we can measure the true value of corporations through IWAF, we can also manage it. I mean, what gets measured gets managed, right? And when we do, corporations can, through the impact-weighted accounts framework, decide, for example, to no longer base their corporate remuneration solely on their financial value, but rather base it on their impact on society and the environment as a whole. And by making it visible, we could decide to even pay up for the negative impact we have on the environment. We can make sure that we pay for deforestation, for toxins and chemicals released into the atmosphere, to de-incentivize it. Because if we do not start to manage those negative, for example, environmental costs, they will still be paid for. But if not by polluters right now, then those costs will be paid for by my generation in the form of floods, in the form of droughts, in the form of climate-induced famine. So it is incredibly important and a case worth celebrating that we have an open access framework that is able to show this right now. Now, additionally, with IWAF, we get the complete picture on the financial value of companies, right? And on a financial value, that is incredibly important. I mean, we've all seen that there are countless businesses that are dealing with stranded assets that just like that turn out, you know, to lose all their value because of the fact that our reporting right now does not oblige us to take, for example, our environmental capital into account. You know, that CEO I mentioned all the way at the start of my story, right? You know, the one with the gray suit with the neatly combed gray hair, just shy of 6 months after we spoke, be it a very brief form of speaking, but just 6 months later, his company got an audit risk and eventually had to forcibly write off $22 billion of assets from their balance sheets in just a quarter term. Just like that, due to, amongst other things, the foreseeable influence of climate risks on their company that were not calculated in. Now, if we do not measure the environmental impact of companies, we won't know which companies are healthy and which will have assets destroyed by stranded asset risk. And that is an actual hazard to the stability of our economy. And very often from a generational perspective, yes, it is the case that we as current and future generation will inherit the environment and society in the state in which we leave it behind. What we, however, don't speak about enough is that we will also inherit the economy in the way in which we leave it behind. And if that is an economy in which the true value of corporations is not properly represented, then that is a hazard to the stability of that economy that we will inherit. Now, through the impact-weighted accounts framework, we are able to account for that accountability for current and for future generation. And that transparency in itself, and particularly to this generation, is fundamental. Now, there's one final remark I wanted to make, because I found this really interesting when I found out, and that is that as of today, we are closer to 2100 than we are to 1933. Now, you might be wondering, is 1933 just some random year? It is not. It is the year from which our current system of accounting predates. So our current accounting system, which was once established to create positive impact, is almost a century old. And in the meantime, the scale of our problems have changed. And now our response must too. And I believe that with the launch of the IWAF consultation today, we have an incredible, amazing response at hand. So yeah, I want to thank everyone for their contributions. And I'm honestly really looking forward to the discussion later on. So thank you, guys.
Thank you so much, Hajar. I think we should all do a big applause, but we cannot do it all at once. So just imagine there was one, and a huge one, huge ovation. So thank you so much for that. It's so relevant what you said. So many of the points, obviously what gets measured gets managed. Where you spoke about the executive compensation, I think there's a lot happening on the side of integrating sustainability factors into executive compensation. But also what we hear a lot about is now it's in the hands of chief financial officers to tackle the sustainability issues. But in order to get the chief financial officers to embrace sustainability and really take action, we need to learn to speak the language also of the chief financial officer. So I think the sustainability world needs to approximate itself more to the finance world. And this is exactly what IWAFs are also setting out to do, with a focus on impact and with a focus on double materiality. There's a lot of questions coming through, a lot of them being answered. But we can commit that we'll, in follow-up, certainly email to everyone all the questions with all the answers in writing, together with obviously all the consultation materials that you can review and give your feedback on. There's some very detailed questions. There's some high-level questions. My favorite question is, when and how do you plan to mandate IWAF? I like dreamers, and we'll get there, but we need a little bit more time to build the momentum, of course. Now, with that, I think we're looking at a great panel, and I don't want to take any more time and introduce our panelists. First of all, we'll have a keynote speech from Elko van den Ende, who is the Chief Executive of the Global Reporting Initiative, GRI. And we have a very distinguished panel with Renier Indal, the CEO of Osama Equity, Thierry Kumpelman, who is the Global Head of Business Advisor, Reporting and Engagement at ABN AMRO, Hia Liang, who's also a very strongly contributing member of the working group running up to this consultation draft, who's an associate professor of finance at the Singapore Management University, and Renier de Adelheid Toro, head of research at Impact Institute, who I dare say has done the hugest chunk of work together with other colleagues also involved at the Impact Institute on the draft we're looking at today. Now, without further ado, may I just hand over the word to Elko to give the opening remarks of the panel. Over to you, Elko.
Thank you very much, and I hope you can all hear me. And as you see, I'm not in the office of GRI. I'm here in Brussels at the Accountancy Europe office. By the way, we will have our own office here shortly. So I would like to take the chance of the 5 minutes that I have as an introduction to make a plea for what I would like to call the two-pillar structure. And what do I mean with the two-pillar structure? We are living in exciting times when it comes to sustainability reporting. We have seen the incorporation of the ISSB at the level of the IFRS Foundation. We have seen the workings of EFRAG in Europe with their double materiality standards, the first draft batch published not too long ago. And we see in the United States with the SEC going out there with their climate standard of 510 pages. So we are now in the lucky circumstances that there are 3 public consultations running on topics that are related to sustainability. But in order to fight greenwashing, and in order to provide investors with clear comparable data, and in order to make sure that in a stakeholder-centric economic model, if that's indeed the direction we're heading to, that society, stakeholders have the right to get access to proper information on impacts, on sustainability topics like environment and socio-economic cohesion. And we can only achieve that by making sure that the global reporting infrastructure on sustainability is aligned and converged. And that's what we mean with the 2 pillars. 2 pillars of equal importance. 1 pillar on the enterprise value effects of sustainability topics on the value creation of the reporting entity, the financial side. And on the other side, we have the impacts companies make on the environment and socioeconomic cohesion when they try to achieve their strategic objectives. 2 sides of the same coin, one on financial, the other one in impacts, one with the lens on investors, the other with the lens on society as a whole. But both equally important because we see investors looking more and more and more into the impacts. I hope you all have followed the general shareholders meeting at Amazon and the highly, let's call it, politicized initiatives by a group of investors representing $3.6 trillion on impact reporting on behalf of Amazon, in this case, tax amongst others. Why the two pillars? Why a system based on the one hand on the IFRS foundations, ISSB standards, and on the other hand on GRI? That's very simple. It's a proof of concept. This already exists for more than 20 years. GRI exists this year, 25 years, by the way. So we have our celebration in October. But we already see that more than 10,000 large multinationals report voluntarily under GRI that also already report under international accounting standards or financial accounting standards. So why change? Secondly, the infrastructure, when it comes to the resources and the capabilities of sustainability standard setting with this combination are already there. So it does not need additional investments. Thirdly, since organizations are used to this model, and since this model is a proof of concept, it will keep cost of compliance low instead of introducing something completely new that needs to be adapted and adjusted. And last but not least, it will, as a global baseline for sustainability reporting, provide comparable data for all, instead of having an additional set of incomparable data, making things more difficult. So moving forward with the highly important rationalization and standardization of the international environment for sustainability reporting, let's use what's already there. Let's fight greenwashing. Let's fight needless expenses and by introducing an intricate system. And let's support the two-pillar structure. And bear with me, at this moment, there is full support by capital markets, as well as the large accounting firms, as well as large investor groups, as well as the reporters, the large businesses and entities themselves, for moving ahead with this infrastructure. I would like to keep it here to give the others also an opportunity to share their views. I thank you for your attention and more than happy to answer any questions. Thank you.
Thank you so much, Elko. Another, I think, standing ovation, and wonderful to hear and get that reconfirmation also from you of the alignment and the need to have kind of the shareholder view, the value creation view as baseline. And the other side of the coin, as you say, the double materiality, the impact perspective, where both GRI, the EU standard, but also the impact weighted account framework fits very well in. It would be wonderful to hear from you, and you obviously very much endorse this thinking of the IWAF, but maybe just a one-liner from you, how do you see the fit and the mutual compatibility of IWAF and GRI? If you could respond to that briefly.
It is all about value, and whether value is directly monetizable or whether value has an indirect element of the creation of impacts on society. They are, again, two sides of the same coin. They are inseparable. So I would say that it would not make sense to not take these issues into account when it comes to standard setting and reporting. It is, as they say, they are twins, so to speak. They strengthen each other. The one can, in fact, I think, looking at the future, not do without the other. They drive value for each other, by each other, and through each other.
Beautifully put. Thank you so much, Elko. We have a really exciting panel, and so I would like to kick off and ask first Renier from Summa Equity about kind of your experience with using IWAF. Why have you embarked on this journey? What's your experience so far?
Great. So for those that don't know us, 2 words about Summa. So we're a private equity fund in Europe. We have raised 4 billion euros to date. And our purpose is to invest to solve global challenges. So we thematically are focused around the areas where we do have some fundamental, both environmental and social challenges. We are majority owners in our companies. So we have 24 companies, some within waste and recycling, some within healthcare, just to make some examples. So why using the impact weighted accounts as a starter? Well, our thesis has been, so we've been impact focused since the start and become the largest impact fund in Europe. And our thesis was that if you don't care about externalities, you're going to underperform going forward. So if you want to have tailwind growth in a world that is challenging, then you need to have companies that are solving challenges, not creating them. So our thesis so far has proved pretty good. It's easy for us to measure our financial performance. So our funds to date are some of the most best performing funds globally within our industry. So financially, it's easy to measure. But when we're saying that it's collinear, showing that companies that are actually creating positive externalities are outperforming, how are we going to prove that and show that? So that's where impact weighted accounts come into play. And there's two reasons why I think impact weighted accounts, and it's fantastic to put a figure on things. First of all, then you can measure it with the P&L. So we can look at it from a financial standpoint. Is this company future-proof or not? What would the financials be if these externalities became a cost? And they're increasingly becoming a cost on the environmental side. But there are also costs on the social side, which I think will materialize going forward. So we buy companies owning them 5 to 7 years. We're going to sell them to a buyer who's probably going to have the same length of horizon or even longer. So we need to think, how are externalities going to affect these businesses 10, 15, 20 years from now? And we all know where we're going in that respect. So for us, it's a way to measure what's the real risk, upside and downside, in our portfolio if these externalities became internalized. Well, the good news, just to share some numbers with you, is on the environmental side, our companies would actually have 4% more revenues and likewise more profits and profit margin if we both had to pay for our biological degradation and climate effect, and got paid for the credits for what we're actually saving the earth on that side. On the social side, our portfolio would actually have 11% more revenues, and we've also done the product pillar, looking at 2 of our companies to pilot it, and they would have 3 times as much revenues if you actually took the full product benefit and financialized that. And for me, this is then it's a good measure when we are showing our investors that our companies and our portfolio is future-proof. You know, if there is a carbon tax and a carbon credit, they will actually be more profitable than what is currently. And it's a good way for us to drive the strategy and our value creation plan. Because in our companies, since they are solving some challenges, we also want to see, can we high grade what they're doing during our ownership? Are they solving these challenges even better during our ownership? If not, we haven't high graded and improved them. So it's a good, so our goal is that the impact weighted accounts show that the externalities actually increase more than our revenue growth, because that means that we have solved these challenges in a better way. So it's a fantastic tool to drive this in the strategy and the operational follow-up of our companies. Yeah, that was a long answer. Sorry, Esther, if I got a bit.
That's a beautiful answer. And I think it's just so beautiful to hear kind of the impact-driven private equity approach and the use case you can demonstrate. I think there was also some questions in the Q&A that popped up, like, you know, what's your rationale and what's your approach as a startup to embrace this framework, and why is it worth it? So I think you really answered that really well, and kind of really looked at one of the big segments of the target audience that your answer is a proxy to, in terms of how to use it, what's the experience. And if I may, I would like to jump over to Chair, to you, and to ask for a very, well, also a user experience perspective, but from a very different type of organization.
Yeah, so the user perspective and what we do with impact weighted accounts and the framework for impact statements in our own disclosures and in our own reporting is actually helpful to get a better understanding of where our impacts are. So it's an educational or a learning framework that we apply, and we like the kind of the 3-step approach, where first we learn to measure, and then we learn to report, and ultimately, we would like to learn to steer on these impacts. And I think that's where we still have a challenge, but getting a better grip and a better understanding of where these impacts are, both positive and negative. That's I don't think it's been mentioned enough, but the real strength, I think, of the framework or of the approach is that you look at both your positive and your negative impacts. And by getting a better understanding of both those sides and a deeper insight on where they occur, you're ultimately better equipped to steer on that. So to reduce negative impacts and to improve your positive impact. And I think that's been really helpful for us. We're still on that journey very much, and we're trying to collaborate with other financial institutions, mainly banks, because we see some specific challenges for our own sector on how to do this well and in a comparable way. That's why we've set up the Banking for Impact working group. But it gives us great insights and transparency. And we've received some positive feedback from a lot of our stakeholders as well on the level of transparency that we do in our impact reporting and our ip&l that Adrian showed earlier.
Thanks so much, Jan. I would like to come back to this and ask you a few more questions on that. Just to kind of finish this or move on with the circle though, and I will come back to you in a moment. Rainier, if I could ask you on behalf of also the Impact Institute, kind of having worked so much and thought so much about the framework, what do you think, who are the key stakeholders to be involved to make this a success, to make your own impact-weighted accounting a success?
Thanks, Esther. Yeah, interesting question. I think it has two dimensions. I think first of all, we mentioned a couple of times that there is multiple stakeholder groups that IWAF assesses impacts for. I would say always try and talk to each of those stakeholder groups. Talk to your employees, talk to your local communities, talk to your governments, and the ways that we, from a theoretical perspective, think we create value for them. Does that resonate with them? And do they recognize the positive impacts? And maybe are they able to mention the number of negative impacts that we haven't talked on? So those are, I would say, the external stakeholders. In internal stakeholders, with Impact Institute, we've worked for a number of clients. Cheert was one of the clients when I started first here 7 years ago. I'd say in many cases, our very first contact persons are either the sustainability managers or the reporting managers. But once we work with them, we help them understand their own impact. We slowly move through the organization. And for instance, in ABM, wrote this has been on the board agenda a couple of times now, and we're really proud of that. And I'd say, find an opening, use this as a talking stick to talk to many people, and in the end, this is a way to help shape the strategy of your organization.
Thank you so much, Rainier. And again, to come back to you to elaborate more on how, if I may turn to you and ask her from your perspective, what is the current view around impact measurement in a different geography, a bit of a Asian context, and also your sort of that maybe Asian academic context, if I may?
Thanks, Esther. So as you already mentioned, I have two hats. First, I'm Asian. I'm located in Asia. Second, I come from academic background. So I think for the Asia part, I'm now co-chairing this Singapore Green Finance Center together with my colleague Dave Fernandez, and we do talk to quite a few organizations in Singapore, in China, from other Asian regions. I would say impact investing and impact reporting, this is still at the infant stage in Asia. Some organizations, they are aware of the importance of measuring and managing impact, but they don't know where to start. So that's why we are still in the early stage conversation with a few banks and also real estate companies on how to first help them to understand impact measurement, and then one step further, how to apply IWAF. From the academic perspective, as a member of the working group for IWAF, I was also in charge of, some parts of the conceptual framework, but also to compile a long list of reliable sources and databases. And I saw earlier in the Q&A section, there were questions about, how do you decide on monetization factor and how do you really, draw data from reliable sources. So I think that is a very important feature of the IWAF, I would say, compared to other frameworks and standards, in the sense that, of course, it's open source, but we rely on, highly rigorous academic research and on, widely used data sources, databases, such as those compiled by World Bank. A very simple example, some economists, including Nordhaus, Nobel laureate in economics, estimate, for 1 ton of CO2 emission, that's roughly, $30 to $40 cost to the society. Of course, this number may vary if you look at, the same tons of emission in Asia. But the idea is we do have a lot of, rigorous academic evidence trying to link impact in their natural units, whether it's positive or negative, into social benefits and social costs in monetary units. I think another important aspect of impact measurement that was probably not mentioned in earlier discussion was this so-called counterfactual thinking, which is extremely crucial for doing academic research. When we want to measure impact, we always try to find the benchmark. So what's the reference scenario? So that means the impact that an organization or an investor creates is relative to absence of this investor, but maybe some other investors or some other organizations maybe present. So I think that's another distinct feature of the IWAF, and that is totally in line with academic research. And I think the third aspect I want to mention is this incentive alignment, because that also highlights the importance of monetization. And from our experience talking to investors, organizations, whenever you tell them to report their impacts, their first question is why? What's the significance of that? Of course, you can highlight the materiality of the risk, but if you still present investors with numbers using different units, some in dollar amount, some in their natural units, they still don't know how to make decisions. But if you present all the information in the same unit, namely monetary units, that's the units they're familiar with, then it helps to align their interest and align their incentive when they make a decision. So I think this is how I want to approach this question from an academic as well as from an Asian perspective.
Thank you so much, Hao. You covered so much ground in just one answer. And I think, again, it would be nice to have a follow-up question on that. But first, I wanted to come back to Chad again to ask you, we mentioned before, all eyes on the CFO. The chief financial officers need to see the value in integrating sustainability in their key strategic decision-making. So I was just wondering if you could say a few words about the benefits of reporting on impacts in the case of ABN AMRO, and did it help with getting through to the CFO, and how has it influenced decision making?
Yeah, and it's not just the CFO. The CFO is relevant, specifically related to reporting, and it's the finance function, especially within a bank, is a dominant and important stakeholder in this space, and we need them, and we need to get them on board on the modeling and the data side for impact reporting and impact measurement. So that's definitely a crucial stakeholder. And to be fair, that's also a continuous journey that we are on. So we are seeing more support within finance, but to truly influence it, to use the impact data to influence decision making at bank level and at board level, I think it needs to mature a little bit more. I think it needs comparability. It needs some consistency over the years, and we've been building this for a couple of years already, and now we're starting to see that the language around impact reporting and impact measurement is getting a little bit more commonplace within ABN AMRO. But we're definitely not there yet. So we need to do a lot more work on embedding this into decision making. I'm also on the positive side, or on the little bit more optimistic side. I'm quite convinced that at most levels, impact is part of the decision. but it's not structured in the way that we are doing this for our impact disclosures and in the framework. But when reaching any decision significant to a company, in my case, or in our case, ABN AMRO, I think we'll always be looking at impact on different capitals and on different stakeholders. I think where the strength of this framework comes in, and of the impact reporting that we are trying to develop, is that it is a more structured way of approaching it, similar to the agreements that we've made many years ago on financials, and how we calculate cash flows and project them to the future. That firmness is still needed for impact and under construction, but I'm quite convinced that the foundation is already there, and that most companies, and including ABN AMRO, are quite open to building this further.
Perfect, thank you so much. And you speak to streamlining, right? And that in the end raises the question of how do you drive more attention? How do you drive adoption? Because it's only by broader adoption that you have more standardization, more comparability, more of a robust body that you can build on. And I think that's very important to understand, that what we're looking at now, the draft framework up for public consultation, is a step into that bit of unknown, somewhat known, but so much more energy needs to go there, and so much more adoption needs to be in place in order to drive that further. And that would be a kind of a concluding question that I actually would like to ask everyone, make a quick round, to ask everyone, how do you think this initiative and this approach can scale, and how can we make it more mainstream? And a subset of that question, maybe then when it comes to how, would be kind of also from an academic perspective and from your experience, how do you stand behind the methodology currently that is on paper in terms of the monetizations, the trade-offs, how can we build confidence that this is the right step in the right direction? But if I could ask us to go a bit of a quick round and just kick off with Elko really briefly, and Reinier, and how, if you could pass the word along. Thank you.
I think there are two things to do. The first one is get academic acceptance. So see to it that you have quantitative and qualitative evidence on the methodology. And the second one is a bit less prosaic: lobbying. Lobby. Speak to everyone, speak to decision makers, both in the regulatory environment as the non-regulatory environment, and keep marketing that what you believe and where you stand behind of. But that with indeed the backing of academic evidence on the methodology that you use. That will be my advice.
Thank you so much, Elko. Reinier.
I guess it's Reinier. I can answer. So I mean, we the way we are going about doing it. So we have some of the largest and leading investors in the private equity industry in our fund. These are large global pension funds, sovereign wealth funds. And so what we are doing is that we are just showing in our reporting how this is collinear, how the returns we are creating is collinear with the impact with the accounts and the financial and the non-financial or the value of the externalities that are creating. And then hoping then that this is a good measure of how future-proof and how the value creation and the forward-looking risk and opportunity is in our portfolio. And hopefully then they will go to the other private equity firms, which they're also invested in, and ask them to do what Summa is doing. So we hope to spread the message by showing that this is a very, very good indication of how future-proof your portfolio is, and whether it will create superior returns over time or not.
Beautifully put, Reinier. And just to confirm that indeed working for an asset manager very much relate to the challenge of the sustainability information or the ESG information that you look at these days as an asset manager, as an investor, is very much backward looking, and creating something that helps you think about the long-term vision around the value creation for all stakeholders is a hugely important and helpful step. Thank you. Chair, any final thoughts on this one?
Yeah, yeah. And when talking about value creation, has to also look at value destruction, right? Or negative impacts, which can be quite large. I like Ilko's call to action on lobby and engaging with as many as you can. I think investor pressure is relevant here. If investors don't ask this of companies, then why? Well, let's flip it. If investors start asking these questions, then companies will be more inclined to do this. And I'm also a big fan of doing this sectorally. So in a sector approach. So the Banking for Impact session, inviting other banks to come and join us and to together improve the methodology or learn from each other, exchange best practices. I think that's really helpful. And we've been doing that with UBS and Danske Bank and DBS, and now Kijks has joined as well. And I'm hoping many others will join soon. So building the network, building a coalition, doing an outreach to investors. I think the regulator will also play a role in this, and I see a lot of regulations coming our way that include at least terminology around impact. I'm not sure they all mean the same, but the terminology is there, and let's help them write this up correctly. So it's a bright future for impact.
Thanks so much, Jared. Renier, if you wanted to have your wisdom in as well on this one.
Yeah, well, first of all, of course, I want to steal some grass before Werner's shoes. We're holding this webinar to open the public consultation. So first of all the viewers, please answer our consultation questions. Tell us what we can improve. Secondly, I echo what Reinier and Tjeerd say. Investors have started doing this, more shoots. Companies have started doing this, more shoots. And there's been a couple of coalitions. Tjeerd mentioned the Banking for Impact Coalition. Here in the Netherlands, we have a infrastructure coalition. Those are also massively important. And lastly, as Ilko said, lobby. We are talking to many standard setters, policymakers to adopt elements of IWAF. I mean, ideally IWAF as a whole, but we'd be very happy if it's elements from IWAF, such as the value chain responsibility. We think that's really crucial that organizations look at their entire value chain when they assess impacts. And yeah, we would really like to see this becoming more mainstream. 10 years ago, everyone thought this was impossible. We're now here, and let's see where we are in 10 years.
Beautiful and wise words, Reinier. Thank you so much. How, over to you.
Okay, thanks, Esther. First, I completely agree with Elko. We need to get more academics to be involved. Of course, it's more credible if Elko said it than me as an academic. I say it. Second, I think we need more synchronization and also unification of standards. I think someone mentioned earlier that there are already many different standards. So is IWAF just a different standard, or is actually collecting all the important elements of other standards? This also reduces the confusion among the users. I think the third point is organizations over time should realize the importance of data sharing, not in a competitive way, but in a collaborative way. From our conversation with some organizations, they keep on saying, if you require us to report our scope 3 emission, whereas our competitors are not reporting that, it only makes us look bad because our emission amount will be much larger than the competitors. However, if all the companies, whether they are competitors or whether they are alliance, they all report scope 3 and they realize how this may help each other better understand the whole ecosystem. This will better incentivize companies to join this more standardized way of reporting.
Thank you so much. Couldn't have put it any better. We only have a few minutes left and a very important speaker, but I just wanted to recognize that yes, we'll answer all questions and everybody will receive a copy. And any other comments and documentation that has been shared, we'll certainly make sure to circulate that. But without further ado, I want to introduce our last but very important speaker of the day, Werner Schouten, who is a bit of a rock star in the Netherlands for sure, for his commitment to climate action, and also the incoming director of the Impact Economy Foundation. Werner, over to you. Thank you so much.
Thank you very much, Esther. And I think when we started off this webinar, you mentioned that we would be making a bit of history today. And I think we sort of did a fair bit. We're doing this public consultation, of course, of the IWAF in rather turbulent times. I mean, multiple problems come together at this moment, ranging from the climate crisis to droughts to resource and food scarcity. And I think the consequences of externalities become these days much more material, not only in our balance sheets or in our P&Ls, but also in our day-to-day lives. And I think Hajar very nicely put this also, the urgency and the importance to address this and to ensure that we no longer live at the cost of generations elsewhere or generations in 2100. And for that, which I found a very nice thing, so I'll borrow it from her, that we need to change the rules. We need to change the rules and the information on which we base our decisions, not solely anymore on financial capital, but also including social, human, and natural capital. And I think once more in this webinar, we've seen that IWAF is very well fit for that. So on various aspects, to give some closing remarks on what I've seen also today, there are things to be positive about. We see sort of the trend towards integrated thinking, reporting, and decision-making is picking up speed. The trend on impact-weighted accounting, as Ethan also showed, is picking up speed. And at the same time, that's also fully understandable because, like the panel showed, it is feasible, it improves decision-making, it can reduce risk by internalizing externalities. So amid this turbulent time, I think for impact-weighted accounting, there is some hope for the future. I think that's also literally what Tjeerd mentioned. So as we're crafting towards the impact economy, as we're working towards it, I think that's a very hopeful thing to see, and that we are slowly building an economy in which innovation, work, and entrepreneurship not only contribute to financial capital anymore, but also just to the well-being of generations in the here and now, and the generations elsewhere and in 2100. The question that we have to ask ourselves is, of course, at what pace? And I think the poll that we did at the start was a reality check in that, because we're all well aware of the material impacts that companies make on the world and how influential they can be, as was shown by the last poll question. But looking at the second poll question, we're not on top of our game. Like, we're not controlling our material impacts, as I think 63% of the participants here also mentioned. So that's why I think it's an important question for all of us, is the question that you, Esther, asked at the end of the panel session. How can we grow and scale this initiative to ensure that impact is part of decision making, and to ensure that it's also part of governmental regulations and market incentives to maximize welfare productivity? And I think that's a question for all of us to take into and to see how you can shape your own response to that. I think we've seen a lot of nice suggestions also in the panel. We should expand it, of course, bring it under the attention of a wider community of business. But at the same time, and I think that's also what Tjeerd again mentioned, is that once we measure and report impact, it's also important that we integrate that into our decision making. And that's maybe one of the key points. Now, aside from that, and that is of course what I want to close with as well, we're here at the launch of the public consultation. So especially also in the short run, for all of you listening now, I think one valuable step is of course responding to the public consultation of the IWAF. It's open up now till the 9th of September. So please be critical on it so that we can jointly create a robust framework in which we can measure, value, and steer on impact. And not only do that perhaps by yourself, but also motivate colleagues, motivate partner organizations and other experts in the field to actually work on this. For the practitioners that are motivated and become enthusiastic about IWAF because of this webinar, we also organize a webinar for practitioners to really dive into the details and to really go into the nitty-gritty stuff. And that will be on the September the 1st. Both signing up for this webinar and for responding to the consultation, for that, links will be included in the follow-up mail that you'll receive after this event. But at the same time, I think also a link is already shared in the chat, so that you can respond to that directly. And one last thing I want to mention is also what Hajar mentioned is, of course, the 2100 group. That's a community of practice that we've now launched in the Netherlands, consisting of current executives from banks, from supermarkets, from a diversity of companies, and upcoming executives, high potential young professionals working on internalizing these externalities in companies and bringing impact-weighted accounting further. This is now our Dutch chapter that we have with 2100, but soon we'll also roll out it internationally. So if you want to stay up to date about this international community of practice, please also subscribe to our newsletter of the Impact Economy Foundation. Now, with that being said, I'd like to, of course, first of all, thank all the panelists and all the speakers for being here with their valuable contributions. Thank you very much. I would like to specifically also thank Esther for hosting this session. Thanks so much for guiding us through this very insightful webinar, and I think also motivating and optimistic webinar. And finally, of course, also a major thank you to the working group that has been working very hard on the IWAF, and that resulted in these consultation documents that you can all see now. So thank you very much for being present, each and every one of you. Please respond to the consultation, and let's realize the impact economy together. Thank you very much.